Hey everyone, hope you're having a great start to the new year. Just wanted to record a brief video here, taking a few minutes to talk about a brief recap of what we've seen in the past couple of years, as well as what we're looking forward to going through 2024. And really, my hope in this video is to help give some helpful content to maybe empower and equip you with a new perspective or a better perspective of how to view the various circumstances, challenges, and changes that will probably be coming up in the next several months for us. We know this is 2024, so this is also a presidential election year. And before we go down that path, just want to give a quick overview of some historical data and historical perspectives about elections and the markets and how investing works in election years. Shortcut to that is it really doesn't matter. The data shows that and it proves it. But the timeless principles that we use and we promote on a regular basis for investing and building your wealth overall, that does matter. And that's really why I wanted to record this video to help share some additional perspective coming out of last year, going into this year, and how we should think about things moving forward. So, very brief recap. 2023 was a really, really strong year overall. We had a lot of really good recovery through 2023 across the stock markets, the bond markets, a lot of different parts of the global economy. Despite what all the initial projections were for the total calendar year of 2023, if we look back at the reports and the estimations from a lot of the institutional firms, banks, things of that nature, analysts at the end of 2022, a lot of folks were predicting some additional negative downturns, additional downward pressure, keeping the markets low with about an average rate of return of about 7%. I'm happy to share that 2023 did not disappoint. Instead, we blew those numbers out of the water, which I think is a good testament to just the strength of discipline and strength of consistency with committed investors doing what they know they need to do to be successful over time. So 2023 did come out strong. The stock markets were up, the bond markets were up, cash returns were up. Everything was really, really good. And coming into 2024, we're excited to see what happens. So all that said, though, let's talk about some of those key principles that we need to make sure we keep in mind throughout this calendar year, and even moving on beyond that to make sure we have the right mindset for our financial plan. So, my personal philosophy, my personal belief is that financial planning is actually very, very simple. But as we know, things in life that are simple are not always easy. And it's important to distinguish the difference between those two words. Things that are simple are very straightforward. The answer, the solution, the principles, it's very easy to understand, maybe not as easy to follow, we'll say. So things that are easy though typically come quickly, they come simply, or keep mixing these words up, but but overall easy things, they're just kind of natural, right? They feel good. There's something that we can just kind of float with, or fly by by the seat of our pants throughout life. But the reason why I say financial planning is simple is because the key principle around how to be successful in financial planning, what I mean by success being having money to live off of down the road, being able to have sustained resources to provide for your needs and to be able to pass down something as a legacy, those kind of things. It's very, very simple. All you have to do is live on less than you make and invest the margin left over to buy and own appreciating assets. It's really that straightforward, right? Now, the hard part about that, and the reason why I say it's simple but not easy, the thing that makes it hard is there's a lot of circumstances and a lot of influences in our lives that come at us to take away from our margin. That could be debt, that could be taxes, that could be medical scenarios coming up, that could be family challenges, could be external circumstances like an election year, like negative influences, negative talk on the radio, negative talk on the news media, whatever that may be, there's always going to be things that come at us on a regular basis. And we have to make sure we have that right mindset and have true core fundamental principles to fall back on so we don't get swayed by the negative circumstances that do come at us. Because one of the worst things we can do is let the emotions of our life lead us to consider actions that might or might not be in our best interest over the long term. So again, financial planning is very simple, right? We need to live on less than we make, have margin in our life and use that margin to invest to grow our wealth, to improve our financial position over time, whether that be paying off debt, buying and owning appreciating assets, using that margin to be able to enhance or advance where we stand financially to create more opportunities and just a more enjoyable life over time. So when we think about that, though, one of the key things I mentioned is that we have to use that margin to buy and own appreciating assets. From our perspective, that is the only way to build wealth. You can't build wealth by buying things that go down in value. You have to do it by buying things that hold value, have value, retain value, and ideally increase in value over time. When we think about the public markets, that's really three different types of assets. That's stocks, bonds, and cash. Stocks represent ownership in publicly traded companies. Bonds represent a debt relationship where you are actually the creditor loaning your money to companies or governments for a defined amount of return back. And then cash is where you can park your money in a safer capacity to get a lower rate of return, but have a much less risk to the original principal balance of your assets. I'm going to focus on stocks and bonds here for a brief second. If you think about buying stocks and bonds of companies, what that means is we are actually owning a representation of the products and services that we all use every single day. My family, we shop at Walmart for our groceries predominantly. We buy clothes from through Amazon. We buy gas from QT or whatever other major gas chain is around. When we do that, we are promoting the business, promoting the profitability, promoting the growth of the companies that we also own inside of our portfolios. So, what I want you to think about is as we go through this next year, how can we make sure we are aligning our financial resources to have margin to buy and then also own for a really, really long time the types of assets that will help us grow our wealth over time or sustain our wealth well into the future? One other thing I want to point out with that is when you do own these assets, especially in the publicly traded markets, we will see markets fluctuate. And that's one of the things I want to talk about here in a second, just about the fact that we are in a year that's going to be more politically charged. Is when you own assets, the values do fluctuate. But the only way you lose money on those is if you sell them when they are at a value lower than what you originally purchased them for. So we know investing is a long-term process. The earlier you start, the more money you put in, the earlier you start, the better returns you could potentially have over time. But also, it's not just about when you start and how long you have before you need the money. It's also what you do with it when you're at that point of needing the money. So we do expect that we're going to see volatility like we do all the time today, throughout this year, throughout the next 10, 20, 30 years, right? We also know that over the past 100 years, on average, the market has dropped about 10% in value at least one time throughout the year over these past 100 years. The past 43, 44 years, it's about an average drop of 15% throughout the year. But regardless of that, over 75% of the time, the markets have bounced back and landed in very positive territory despite these drops. So I say all that to say, there's going to be a lot of questions. There's going to be a lot of concerns. You're going to see a lot of fighting on the news. You're going to see a lot of misinformation that we probably don't even know is misinformation out there over the next several months. And I just want to encourage you to fall back on your principles and fall back on the truths of what you know will help you be successful on your financial journey. A common question that we always get around these times is, or a common question or concern that gets expressed, I should say, is that this time feels different. And I'll just remind you again, we see volatility and fluctuations on a regular basis. So from our perspective, maybe the specific circumstances that lead to volatility might be a little bit different, but the overall scenario and the results of that are far from different. This is just a common practice, common process throughout the process of building our wealth and sustaining our wealth over time. So I hope that's an encouragement for you. If you have any questions, please reach out to me, let me know. In the next few minutes, I'm just going to wrap up by going through 4 key points about the reality of investing during election cycles. This comes from a company called Capital Group American Funds. They produce a guide to elections every time we have an election year, election cycle, and just 4 key points that to me give me more security and more hope knowing that we've been here before and we're going to make it through this again. So I'm going to share my screen with you guys, and this will also be linked in the email where we send this out. But I'm going to share this and just walk through a couple highlights here. Again, you're welcome to reach out to me with any specific questions following this as well. So this is the guide to investing in an election year, brought to us by Capital Group American Funds. 4 key points we're going to talk about are, first of all, historically, over the past 22 election cycles, history shows that whoever wins the White House does not have a direct impact on the results of the markets. We can see by this mountain chart right here that whether you're a Democratic Party, Republican Party, it really doesn't matter. Over the long term for investors, for really, really good investors, if we hold our assets for a long period of time, that does not make a big difference. This shows an example actually of a $1,000 investment into the S&P 500, which is just an index of the largest U.S. stock companies, or U.S. companies traded on the stock market. A $1,000 investment made during FDR's presidency could have turned into over $19 million by the end of June of 2023. To me, that is a helpful perspective to see that if we are a good investor, meaning we have good behavior, we invest with conviction rather than invest on emotion, we will ultimately see the fruits of our labors. So regardless of who wins the White House, whichever side of the fence you land on, it does not matter to me personally. But regardless of that, we know we're going to see long-term growth moving forward. Next key point I want to show is, and this is more relevant to the next few months, is during election years or election cycles, we typically see a lot more volatility during primary season. So the first 5-ish months of the year, we're going to see more ups and downs. And there's a lot of factors that influence that. I'd say just for the sake of today's call, let's just say it's because it's primary season and things get nasty. And there's a lot of speculation around what's going to happen around laws and things of that nature. Overall, though, despite the primary season being more volatile, we know that once we get through that, we typically see a good uptick of growth on average that comes back up through election day and even beyond through the following year. So this again shows average cumulative returns since 1932 of the S&P 500. We can see just visually these curves go up and to the right, which you might get tired of seeing those things whenever you think about investing, but it's true. And it's the way that it has worked. It's the way that we hope and we expect it to work. There's, of course, no guarantees of results in the future, but we see a lot of historical data pointing to the same results over time. The third thing I want to point out, and kind of tied the third and the fourth thing, is a lot of folks believe that making a move to more conservative assets during an election year makes sense, but that is typically and historically more of the wrong answer, right? I had several clients reach out even last year as they were seeing, the markets fluctuate mid-year. We're saying, hey, should we move to something more conservative? Everyone is talking about a predicted, downturn, blah, 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 things of that nature. And I'll say that thankfully we didn't do that because the markets bounced another 12% following a lot of those conversations. Now, again, not a guarantee of future results, but we know that to invest successfully, it's not just about buying assets that can go up in value at the right time. It's about owning those assets for a very long time. Think about Warren Buffett. He's well renowned as one of the best investors in all of history. He focuses on buying high quality assets and owning those for a very, very long time. That's why he's known as one of the best investors out there. So if you're thinking about moving to more conservative assets, if you're scared by what you see on the news media, anything like that, let's have a conversation about it first, because ultimately making those moves could have a very negative effect on your long-term results. And we don't want to make an emotional response based off of flippancy or anything of that nature. We want to be convicted about why we're holding the investments we own and understanding how that plays into our long-term picture. And then the fourth piece is ultimately that being fully invested, not staying on the sidelines, and actually committing to that consistent investment process historically does pan out better. This here shows an example of out of the past 22 election cycles since 1932. We're talking about a 90-year history here. Those who remained fully invested actually had better outcomes out of 14 of 22 cycles than those who sat on the sidelines and waited to invest after things, settled down, we'll say. Overall, the results are substantial. Those who do sit on the sidelines typically have worse outcomes 16 out of 22 times. And those who are fully invested have the best results. So all this said, I want this to be an encouragement. I want this to be helpful to equip you to have a better mindset or perspective going into this year. We know we're going to see negative circumstances. We know we're going to see challenges. My hope and some other data we're looking at shows that when we have really good years, that typically leads to other good years following that. We just can't guarantee when it is or when it will happen. But we know that if we hold true to the right principles, we operate with conviction over time, that will ultimately give us the best possible opportunity for our own personal success. So again, if you have any questions, please feel free to reach out. I'm more than happy to chat about it. And otherwise, I hope you guys have had a great holiday season and looking forward to connecting soon. Thanks.